Hello everybody. So I will start with a figure, 1,600 billion. This equals to 13% of the European GDP and represents the amount of state aid spent in the European Union to save the European financial system since 2008. Needless to say that it's a huge amount. One of the major challenges of financial regulation is to avoid that this happens again, with all the economic and the social consequences that we know and that go much beyond this amount. However, more than 5 years after the start of the crisis, a lot remains to be done. And Finance Watch and a number of experts, among which academics, regulators, believe, among other things, that a major piece of regulation is still missing: the separation of banking activities. The objective of this webinar is to explain why the separation of banking activities is crucial and why it must remain on top of the regulatory agenda. And then we'll be happy to answer your question on the specific proposal that was made by Commissioner Barnier. So to start with, what are the activities we are talking about? Banks provide basically 3 types of services. They keep our money safe, our deposits, our savings. They maintain the payment system and provide related services, money transfers, cards, etc. And they finance the needs of households, companies and public bodies. This last function, funding the need of the economy, is done in 2 radically different ways. The provision of credit on the one hand, and this is the way we are all more familiar with. The bank lends money to an individual, to a company, to a local authority, a state, to fund a given project. And the bank will follow on the associated credit risk until the end of the credit, until the credit is completely paid back. And there is a relationship management dimension to this activity in the long run. On the other hand, you have another way, which is market financing, which was primarily designed to fund the needs of larger companies, larger projects, and which consists in providing funding to those institutions, those large companies who need funding, making the link between investors on the one hand, available funding, and the need for investment. And there the bank acts as an intermediary. It supports the origination of the debt, for example an obligation, and its trading on the market. So, on the one hand, these two ways of funding the economy are radically different and have been therefore developed and took place in 2 different types of banks. On the one hand, you have the commercial bank, which provides credit. It also keeps deposits safe and provides payment services. And on the other hand, the right-hand side of the slide you see here, the investment bank provides market financing. The funding of this activity is not supposed to be made by deposits. The investment bank seeks funding from investors who bear the risk for these activities and are ready to pay for it. So it's really different. The problem is that in the past 20 to 30 years, commercial banks have been progressively allowed to engage in investment banking activities. And today, we are in the situation where the larger European banks are universal banks, which combine both activities. So universal banks are therefore banks which combine, on the one hand, activities that are literally vital to the economy, deposits, credits and payments, and that cannot therefore be interrupted and must be maintained continuously. Even a one-day interruption can lead to chaos. Imagine, economy very quickly starts to malfunctioning if payments cannot be made, especially when it is at a large scale, if salaries cannot be paid, if suppliers cannot be paid, if cash cannot be withdrawn from ATMs. This is why these activities are called vital, and this is also why they benefit from an explicit public support. So on the one hand, the activities that are literally vital to the economy, and on the other hand, market activities which can be interrupted. The failure of an investment bank, as soon as it's not too big, that requires no public support and does not put the repayment of a security at risk, for example. It can be replaced by another market maker, for example. This difference between those two functions, that can be interrupted on the one hand or not, is really important to understand what follows. And we'll now go to the problem. What is the problem with the universal banking model? The major issue with the universal banking model, as we know it today, is that the investment bank benefits from the public support that should be limited to the vital function in the commercial bank, those functions provided by the commercial bank. But the fact that the two activities are mingled together in a universal bank, commercial bank plus investment bank, makes implicitly the investment bank benefit from the public support, which should be restricted to the deposits, payment system and credit money. And this has a number of very deterrent consequences, and it creates major distortions. First of all, markets acknowledge this implicit support and are more eager to fund an investment bank which is benefiting from a public support than one which is not. And they do it at a better price. And as the bigger the bank, the less chance that the state let it fail, the better the price, the easier access to market funding. So the bigger, the better. This allows the investment bank, which funds its activities on the market, to have easier and cheaper access to funding, and this is in the end done at the cost of taxpayer and can be called an implicit subsidy. And indeed, we are in a situation where we go in a race to an ever increased size. This is what happens indeed. Supported by easier and cheaper funding, banks lend more than they would normally do under normal market conditions. Their market activities become much too big, and for sure much bigger than what the real economy needs. The bank is distracted progressively from its basic functions and dedicate more and more attention and resources to market activities, which in the same time are less and less in relation to the real economy. Then, easy and cheap access to funding, combined with the certainty of a public support, also leads to a decreased attention to the real risk of market activities in which the investment bank is involved. What would you do if a bank would lend you money at low cost, in huge amounts, and if you were backed by a member of your family with unlimited resources? Would you still pay attention to the risks you take? So if the investment bank had to pay for the real cost for the risks it takes, it would certainly not engage in the same activities, or at least not to that extent, as the most risky parts would probably come at a prohibitive cost. In the end, the result is a distortion in the form and the activities of these banks. Overdevelopment of the market-related activities compared to commercial banking, and an increased cost for society in case of a problem, just because the amounts at stake are really huge. And I will illustrate that. Have a look at the pace the top European banks have been increasing in size over the past 10 to 15 years. They tripled in size between 2000 and 2011, whereas the economy was increasing by around 30% over the same period. Which means that large universal banks have been growing 10 times faster than the economy. This growth is directly correlated to the exponential growth of financial markets, which have followed similar curves over the period. If you look at curves of derivatives market, like securities market, bond market, whatever, similar curves over the period, especially derivatives, which is quite impressive. And this makes sense, as large universal banks literally make the markets, so their growth follows the growth of the markets. Comparing each of these top 15 banks with the respective size of the GDP of their country of origins gives a sense of proportion too. See the third column in the table here. A lot of banks are almost as big or even bigger in size than the national production, measured as GDP. And here you understand the meaning of too big to fail. None of these banks can fall. They are too big for the state to let them fail, because it would be a catastrophe for the economy. at national but also at a regional level, because of the threat it would pose on the availability of savings for households and companies. We cannot let them fail because of their size, but a public intervention to save them comes at a huge cost given their size. See the amount of state aid that I quoted in the introduction. So, splitting banking activities therefore aims at protecting vital functions provided by banks, by commercial banks, and only these deserve public support. Splitting the banks also aims at protecting public finances, and it's a direct consequence of the first point. And such a separation, in addition, would also allow to put an end to the subsidy market activities unduly benefit from, and would probably allow to limit the size of the unnecessary market activities. So, you now understand why banks have interest in maintaining the status quo and why they oppose so strongly to a separation of banking activities. This would put an end to a sizable subsidy their market activities benefit from, simply. So huge efforts are deployed by the financial lobby, and in particular the large banks that are concerned in the first place, to avoid a separation of banking activities. A lot of statements have been made to discourage regulation. Many of them are myths, and they need to be debunked. The number one myth is related to the ability of large universal banks to fund the real economy. They say that separation would destroy this ability, that it would make access to credit more expensive, that it would therefore make things worse in a context of a crisis, and that we cannot afford it. But let's look at facts. As a whole, the European banking sector dedicates only 28% of its resources to lending to the real economy. This is really not a lot. So what are the remaining 72% dedicated to? Most of it is related to market activities. And what is the share in this 70% dedicated to the real economy then? The answer is that this share is very limited. And I'll take two examples. The first example is the derivatives market, a huge financial market made by large universal banks to a large extent. In this market, only 7% of the volumes involve non-financial companies. So, this means that you have 93%, which is finance-to-finance activity, which is not facing the real economy. If we take another example, the foreign exchange market, a very speculative market. It's 25 times bigger than the international trade volumes. This is quite a striking image. International trade, which directly needs foreign exchange markets, for example, you have trades between a European and a US company that requires exchanging euros against US dollars. But the needs of this, the size of this international trade only represents 4% of the foreign exchange market. And we observe similar proportions, less than 10% each time, as the one observed on Forex and derivatives, on other financial markets. For example, the bond market is only by 10% facing non-financial companies, which can be taken as a proxy for real economy. So if we try to sum up now this information, this is what we would have at best in a universal bank. Less than 30% of resources dedicated to financing the real economy through credit, less than 10% dedicated to providing market financing to the real economy, and more than 60% of activities that are not facing the real economy. So today, bank lobbyists threat regulators with the risk of an increase in the cost of credit and a decrease in the ability to finance the economy. We would argue that banks today are to a large extent engaged in other activities which do not serve the real economy. The challenge is therefore to put real economy financing at the heart of banking activities and to reallocate financial resources where they are needed. Splitting bank activities would restore the focus of commercial banks, and would certainly lead to a decrease of the size and riskiness of market activities following the removal of the subsidy. Society would win on both fronts. We would add to this that the cost of credit could in fact decrease it's indeed quite certain that commercial activities will be considered as less risky on a standalone basis than when they were mingled with market activities. Lower risk, meaning lower cost of funding, this should lead to a decrease in the cost of funding of commercial banks, not the contrary. Our other counter-arguments include the fact that the simplification of banking structures is better for transparency, in particular for clients, for investors, for citizens as a whole. But it's also better for efficient supervision. So this has more chance to result in a decrease in the cost of funding than an increase. The European banking sector is also still fragile and still benefiting from public support, guarantees in particular, and it's still benefiting from cheap funding from the European Central Bank. So statements that would assume that the European banking sector is safe and sound do not hold, simply. The myth on separation that I mentioned, so that the cost of funding of credit would increase, also forgets about the cost of crisis imposed by the banking sector since 2008. And we are not only talking here of the state aid I mentioned in the introduction, but of the recession that follows the crisis, and the credit crunch, and the impact on public spending, and the increase in unemployment and poverty, etc. So it's really hard to imagine that the structural reform of banks would come at a higher cost than that. To end with, I would like to say a few words about the recent European Commission's proposal on reforming the structure of banks. So the European proposal was released at the end of January 2014. And we as Finance Watch believe that this proposal definitely has the right objectives and it points at the right issues. However, it has still fragile mechanisms and it really needs to be supported and strengthened. So we believe that it's a major challenge for the next European Parliament that will be elected end of May, and that this piece of regulation needs to be on top of the agenda for the years to come.